Hey everyone, this is Kevin Romines with Geneva Financial, Branch 1700. So, what are we going to talk about today in today's video? Well, I think we should talk about mortgage insurance. What is it? Do you really need it? And when do you need it? Is it beneficial for you in some way? Is it also harmful or bad for you in some way? And what is the best way to get rid of it? That and more coming up in today's video. Okay, before we get into the details with regards to mortgage insurance, a little bit of background on the mortgage insurance. I always kind of like looking up and knowing strange facts. Well, this is part of my industry. I kind of like knowing these strange facts. So, when did mortgage insurance come to be, or when was the first policies put in place? Surprisingly, it was 1880s. So it wasn't even in the 19th century. It was 1880s. Holy cow, that's craziness. The thing, and a little bit of history as we go along. So in the 1920s, mortgage insurance was hit pretty hard because of the Great Depression. After the Great Depression, pretty much all the mortgage insurance companies were just broke. They were bankrupt. They ceased to exist. And so in the 30s, they just, went away in total, and they really didn't come back in terms of mortgage insurance, in terms of new policies or new active policies until 1956. So just some weird details there. But, the whole industry got bankrupt way back in the 30s. That Great Depression, it hit some industries on the chin, and mortgage insurance was one of them. Now, what is mortgage insurance? How does it benefit the borrower? So mortgage insurance is a benefit to the borrower because if mortgage insurance wasn't in place, then lenders would ask for larger down payments. So instead of the 5% down, the 3% down, even the 100% financing through maybe a down payment assistance program and those kinds of products, you wouldn't see those products if mortgage insurance didn't exist. You would see products that would, at minimum, would want at least 10% down, but they more likely would want at least 20% down because mortgage insurance wouldn't be in place, and therefore there's not more affordable products. What allows the affordable products to come in terms of the down payments is mortgage insurance. Why is that the case? Well, the lenders know that we've got this mortgage insurance policy that if you, the borrower, default, which no one ever wants that, but if you did default on the loan, then the lender can cash in that policy for not all of their loss, but at least a good chunk, the majority of their loss. They can get that loss covered back through mortgage insurance. So it makes that lower down payment loan less risky for the lenders because of the fact that mortgage insurance is there. So that's how you benefit, right? There are also some protections that are set up in mortgage insurance policies, and I'll get into that later in the video. So we've got what is it, when was it formed, and how is it beneficial to you? Now, what's the downside of mortgage insurance? Well, the downside of mortgage insurance is that it's an additional portion of your payment that is rolled into your overall mortgage payment that makes your mortgage payment more expensive. How expensive is it? Well, it's always a percentage of what the loan amount is. So the smaller the loan amount, the smaller the percentage. The higher the loan amount, the higher the percentage. Or not necessarily, it's the same percentage, but it's a higher monthly amount. So with housing prices what they are today and loan levels at the levels that they are today, mortgage insurance can make up anywhere from $100, $200, $300. I've even seen as high as $400 a month, which is just craziness if you ask me. But it's not necessarily for the life of the loan. So if you do a conventional loan, you can get rid of mortgage insurance once you have 20% equity. If you do an FHA loan, unfortunately, FHA loans with less than 10% down, currently in the current environment, Congress is looking at changing this, but they haven't changed it yet. In the current environment, you're going to have mortgage insurance for the life of the loan. So the only way you get rid of mortgage insurance on an FHA loan is you have to refinance it. However, if you did put 10% down or more on a FHA loan, your mortgage insurance multiplier is a little bit lower, so your monthly the monthly payment is also a little bit lower, and you can get rid of mortgage insurance after 11 years. Ooh, 11 years, my Lord! Why would I want to pay for mortgage insurance for 11 years? If I took out a conventional loan and I had mortgage insurance, because let's say I put 3% down, right? I got in on what's called an affordable loan program. So I put 3% down. So I haven't got 20% equity. I've only got 3% equity. Well, in the state of Washington, the 40-year average, including the meltdown in 2008, 2009, and 10, the 40-year average for appreciation in the state of Washington is 7% a year. So that means somewhere between 2 and 3 years, you're going to have that 20% equity. So on a conventional loan, you could get rid of mortgage insurance as little as 2 or 3 years. If you had a 5% or 10% down payment, you could probably get rid of mortgage insurance in maybe 1.5 years, as opposed to an FHA loan that has it for life or has it for 11 years or forces you into a refinance to get rid of it. So those are some of the things that I kind of wanted to go through before I get deeper into details on mortgage insurance. If you've liked this content, we want you to smash that like button and subscribe. I think you'll find a lot of great content on our channel, and hit us up with any questions. Now on to more details. Okay, so let's walk through some of the details on mortgage insurance. So, mortgage insurance for homeowners who put less than 20% down. Private mortgage insurance, or PMI, is an added insurance policy for the homeowner that protects the lender if the homeowner is unable to pay your mortgage. It is not the same thing as homeowners insurance. It is a monthly fee rolled into your mortgage payment that it is required if you make a down payment less than 20%. So again, mortgage insurance, it's going to come into play if you've got less than 20% down. There are some other techniques that you can use to avoid the mortgage insurance, even if you have less than 20% down. I'll get into that in just a little bit. Mortgage insurance, aside from letting you bring less cash to the closing table, your PMI policy may come with some built-in protections. For instance, some insurance companies include job loss protection as part of their coverage. So that was interesting. Even I wasn't aware of that until I researched some of the policies. The benefits you can receive depending on the policy's guidelines, and you may be limited to how much time you have to file a claim after buying a home. It is important that you read the fine print. Some PMI providers will also do something known as a partial claim advance if you get behind on your mortgage payments and end up facing foreclosure. That's, again, another benefit that most people are not aware of. Read the fine print on your mortgage insurance. You need to know, do those protections exist in your existing mortgage insurance? Getting rid of mortgage insurance. One of the methods is you could use a piggyback HELOC loan in combination with a regular first mortgage, up to 80% on the first mortgage, for any amount over 80% loan to value, up to 95% loan to value. So let me clarify that just a little bit. What you're going to do is you're going to do a combination first mortgage and second mortgage, or HELOC. HELOC stands for home equity line of credit. So what you would do is you would do the first mortgage up to 80% of the appraised value, and then you would follow that up with the HELOC up to 90 or 95%. By doing it that way, and then you're gonna have about 5% down payment in that kind of situation. By doing it that way, instead of having mortgage insurance, you've got a second mortgage payment. So you don't have the mortgage insurance component as part of your mortgage, but you do have a second mortgage. And typically that second mortgage payment is cheaper or less expensive than mortgage insurance is. So that's why a combination regular first mortgage up to 80%, and then a HELOC for up to 90 or 95% from that point, and then also your 5% down payment, you can avoid mortgage insurance altogether. Another way is through appreciation gain. As you pay down your mortgage and you also have good appreciation in the area where the home is, as soon as you get 20% equity or your loan is now at 80% of the current market value, you can ask the lender to remove the PMI. Now, I will say the one thing about that is, so you're going to call up the lender, they're going to say, okay, we're going to need an appraisal to prove it. So you're going to have to pay for an appraisal. And then once the appraisal comes in, if you've got the 20% equity, then they'll just go ahead and remove it. And so again, they'll make you pay for that appraisal to prove it. Getting rid of mortgage insurance, pay down your balance. You could pay down your balance so that you have 20% equity or more. In doing this, you can also request that the lender recast your loan. Well, let's get into what recasting your loan means in just a second. By recasting, this will also lower your monthly payment by the amount that you paid down your balance beyond reducing your payment from the PMI removal. So you're going to remove PMI by having paid your mortgage down to the point where you've got 20% equity. So that's going to save you some money. It could save you $100, $200, $300 a month, depending on what your mortgage is. And then you're also going to ask them to recast. What is recasting? So when you ask them to recast, let's say that you paid $20,000 down on your mortgage. So your mortgage was $270,000 before. You paid $20,000 down. You got it down to $250,000 because your appraisal came in at $320,000. You've got that 20% equity or more at that point. So they're going to remove the mortgage insurance. That's going to save you $100, $200, $300 a month, somewhere in there. Then they're also going to recast. Recast means that they're going to take the new balance that you've paid it down to, and they're going to re-amortize that over the amount of years that you have left. And so because you've got a new lower balance, then that's going to lower your payment. So you get a double whammy on a case like that. You're going to reduce it because you're getting rid of the mortgage insurance, but you're also reducing it because you are recasting the loan. So the two alternatives that you have when it comes to recasting is, one, you can ask them to recast and that will lower your monthly payment, or you can ask them not to recast, and then that just means you're going to pay your mortgage off that much quicker. Okay, I hope you found that interesting. There's definitely some details in there that surprised me even. So I love learning those little unique facts, and I hope you picked up enough information that you can make quality choices when you're in the market for a mortgage, or maybe on your existing mortgage. There's different things that you can do there that would benefit you from that. So I hope you found this interesting. If so, please, again, smash that like button, and also hit that button to subscribe, and don't forget about the notification bell. You want to be notified every time we get a new video. So until next time, see you again.